As a trader, most of the time you feel stuck trying to come up with an idea to build a trading strategy. But what if I told you that there is a secret method to easily build a strategy on any instrument you like? And that secret method is intraday seasonality. This method is so good because you don't need to come up with an idea. The pattern will be there and you just need to find it and trade it. And I'm going to show you how to do this very easily. If you are a stock trader, then you are used to the day session. This would be in the US from 9:30 to 4 p.m. In Europe, it's a little bit shorter, and it's also short in Asian stock market. But Forex, futures, and crypto trades 24 hours a day. And of course, that attracts different type of traders during different time of day. So for example, we have the US session, we have the Asian session, and we have the European session. And each session attracts different type of traders. So our job as traders is to easily find a pattern intraday during one of these sessions. And then we trade that pattern. So for example, I have the US Australian dollar here represented by futures. And in the background, I have an indicator that plots a different color for every session. So the green session is the Asian session. So this would be Japan, New Zealand, Australia, Hong Kong. And then the yellow part is the European session. So France, Germany, UK. And then the red part is the US session. So that will include Canada and the US and Mexico. Of course, they do overlap, and it's up to you to define where those sit. So for example, here is my definition. So London session from 2 a.m. to 9 a.m. This is defined in the Eastern Standard Time in the US. And then New York session from 9 to 5 p.m. And then the Asian session from 5 p.m. to 2 a.m. Like I mentioned, of course, you can change these definition up to. So going back to our chart, the white candles are the price, and the yellow curve is the ATR of 2 days. And then at the bottom, we can see the volume. So immediately I can find a volume here that usually the last hour in European session and first hour in the US session has a spike in volatility. You can see even though the ATR here is very high compared to this one, but the pattern is still the same. So high volatility and go back to low. High volatility, go back to low. High volatility, go back to low. And this pattern, of course, does not repeat every single time, but usually it's there. High and low, high and low, high and low. Now, this will be hard to find if you are just looking at the chart. Now, in this case, it was easy. We can find volatility spiking usually in the overlap hour between European session and New York session. But to really find a pattern that you can trade easily, you need to use some math, and that's very easy. We need to think about it this way. If we have, let's say, the last 15 years of data, then we bring every hour of every day of that year and stack it up. So, for example, we take Monday, 8 a.m. to 9 a.m. We stack every single Monday, 8 a.m. to 9 a.m. on top of each other, and we take their average. So let's say the average of 8 a.m. to 9 a.m. of every Monday, we make $10 if we buy and sell the close, like we buy the open, sell the close. Then we bring 9 a.m. to 10 a.m., 10 to 11, and so on and so forth. So we end up with 24 hours, so that 24-hour cells. Each cell represents that hour on that day for the past 15 years. Now, there are many ways to do this through programming, and of course, you have a Google Sheet and Excel sheet. So this is an Excel tool that does exactly what I just described. So you see here we have 24 hours in every day, so from Sunday to Saturday, and then it just stacks every hour of every day for whatever data you have. In this case, we have more than 17 years. Now, this tool is provided to my Algo Trading Masterclass students, but like I mentioned, I described how you can do it. And now we don't need to look at the charts for the past 17 years. We can easily find patterns. So immediately we notice that Wednesday trends up, and somewhere in Thursday, we trends down all the way to Friday. And then last 3-4 hours in Friday, we go up. Of course, we know, so this is, let's say, midnight Wednesday, all the way to 4 a.m. on Thursday. And then we go down all the way to 11 a.m. on a Friday, and then we go up. We also can find this here. So this is the average win-loss in dollars. Look at this. So normally, let's say this is 0.21. That hour doesn't give us anything. $3, $4, but then we find something interesting. For example, this one, 10 a.m. to 11 a.m. on Wednesday, we lose $6.7 on average. And this hour, we lose 7. This hour, we make 11. And then we have some stacking happening. So look at this. If we short the 9 a.m. open of Thursday, and we cover our short by 11 a.m., we make on average $20. So this is a huge edge. And like I mentioned, if we buy Wednesday at 12 all the way to Thursday at 4, so you can see I can pick the cells and also add to them these one up to 4. And look at this, $63 on average. And if I short from 5 all the way to 11 on Friday, then also I will make $60. So these are huge edges because the Australian dollar futures, the single tick is $5 and the commission is like 1.5. So 2 ticks in and out, that's $10. With commission, that's $13. So $13 will cover the in and out with slippage. So 60, it's like 4 times already the slippage and commission, which is what I teach, that you need minimum of 4 times slippage and commission. Now, once you find this pattern, you need now to test it in your trading platform. But the rules are very easy. You know when to enter, when to exit exactly. Of course, you can test other choices and see which one is better. Now, the tool is based on 60 minutes, although the concept can be applied to anything. It can be applied to 1 minute, to 300 minutes. The problem is this Excel sheet tool that I built is on 60 minutes to make the tool usable, because if you try to make it customized or you put more data in, like for example 15 minutes, that means you're loading more bars and it becomes very cumbersome and the tool will be very slow to respond. So to combat that issue, in Algo Trading Masterclass version 2, which is coming out very soon, I took this to the next step, which is now I have a program that scans all the data for the whole week and find out the best patterns and let you know. It's actually give you all the patterns and then you just need to sort which one is doing what. So roughly you get about 15,000 strategies per instrument on 60 minutes. Now, if you increase that, then you increase the number of variations. And if you reduce that, you reduce the number of variations. So because this is now an algo, so you can now build it on 240 minutes. You can build it on 300 minutes, 265 minutes. It doesn't matter. You can build any blocks. And then you can find different patterns that usually other traders cannot find. So here is our tool applied to 60 minutes Australian dollar futures. So this is the US dollar, Australian dollar represented by futures and 60 minutes bars. And at the bottom here, I have the daily bars. The reason I have daily bars is because we're going to use it to apply filters for our strategy. So here is our algo optimization. First, we have long and short. So we are testing all the longs and all the shorts. And then we are testing for day of the week. So 1 to 5. And then we are testing the start time, so 0 to 2300, so that's midnight to 11 p.m. And then the number of holding bars. So remember, this is hourly time frame. So 40, that's less than 2 days. So theoretically, if I want to test everything, this should be around 100, because 100 hours is roughly 4 days. And of course, you don't want to hold like more than 4 days, because we only have a week. Remember, the pattern will repeat the next week. So if I do 100, you will get about 24,000 combinations. This is, remember, on hourly time frame. If this is 15 minutes, then you can imagine this, of course, will keep growing. But it doesn't matter how, like you can have here 250,000 combination. You can always use the genetic to filter the strategies. But in our case, like I mentioned, 40 is enough because, I mean, we're cheating, but we already know our pattern is less than 1.5 day. So 40 should be enough. So that should give us about 10,000 combinations. So I have here the results sorted by return to drawdown. Now let's look at the average rate. Remember, the slippage and commission is about $15. So we really need at least $30 per trade on average to really use that strategy. Remember, we can always enhance the strategy with a filter. So let's filter for 30 and above. So now looking at the results sorted by return to drawdown, look at these patterns. So 2 is long and 1 is short. This is the long and short filter. And this is day of the week. So 3 is Wednesday and 4 is Thursday. And then this is the entry hour and the number of holding bars. So keep an eye here on the day of the week. So we have 3 and 4. Here is 2. So the first 2 is number 35. And if we look at this trade, so it's entering Tuesday at 10 p.m. So this is long, Tuesday at 10 p.m., holding for 31 bars. And if we look closely at Tuesday, so Tuesday at 10, it's over here, holding for 31 bars. So that's 2 bars here and 24 on Wednesday, 26, and then 5 bars. So that's about 5 a.m. So basically, this pattern is trading the same Wednesday pattern. It's just starting it early over here. And that's why it's number 35 in terms of return of drawdown, because we're holding more bars and most likely we're facing bigger drawdown. Now also we notice something else is good. So for example, this is 2, that means it's long on Wednesday. So 4 p.m. holding for 10 bars, 7 p.m. holding for 8 bars, 7 p.m. holding for 9, 6 p.m. holding for 9, 4 p.m. holding for 11. So that tells me also something else, which is this pattern is really good because it doesn't matter where I start or how many bars I hold. I'm roughly achieving the same average trade, which is around $40. And if I want to go by the average trade, so the maximum I have is $61, which is short on Thursday at 6 a.m. holding for 28 bars. Next one, again, $60, same pattern because I'm shorting on Thursday, but this is just starting earlier, 4 a.m. Next one, same pattern, starting at 6, but now instead of 28 bars, holding 26 bars. So you see all these are the same pattern. So here is the pattern applied, and let's look at the performance. So we're making 53,000, and this is the equity curve. Trade analysis, 867 trade with $61 on average. And the annual period analysis looks like this. So literally within 15 minutes, we can build a robust strategy on any instrument. Now, of course, this strategy already good and tradable, $60 on average on the Australian dollar is very good, but we can easily enhance that with a filter. So if I want to compare this strategy to the regular strategies that I do on the S&P 500, where they usually make about $400 on average, this will seem like low average trade, $100. But let me show you the comparison between these two. So to trade one E-mini S&P 500 contract, you need about $13,000. So this $13,000 go up and down with volatility. When the volatility increase, all margin for all futures goes up. And when the volatility decrease, they go down. But this is the requirement in June 2024. So it's about $13,000 to trade the S&P E-mini futures. Now the micro futures is 1/10 of the S&P E-mini. So that's why you see here the margin requirement is about 1,300. But now let's go down and let's see the Australian dollar. So Australian dollar currently at the same time is about 1,600. So if I want to compare the S&P 500 average trade with the Australian dollar average trade, then I have to trade about 8 contracts Australian dollar futures for every E-mini contract on the S&P 500. So without playing with the code, we can do this in the strategy properties. We can increase the fixed shares contracts to 8. So now we have $210,000 we are making, and our average trade, of course, will increase to 775. So compared to the S&P 500, this is a really, really good strategy. Remember, we didn't apply any filter yet. Next, we can do the same procedure for the long side. So we pick the strategy for the long side, and we know that pattern already from the chart. And then we find the best average trade. We apply filters. And also, we will use 8 contracts so that it's comparable to the S&P 500. Now, the long and short, they don't overlap. So that's great. We can combine both the long and short in a single strategy, single code, using the same capital. And here we have the 2 strategies applied. So this is short side on Thursday at 6 a.m. holding for 28 bars. And then this one is the long side on Wednesday at 4 p.m. holding for 11 bars. So as you can see, they don't overlap. And of course, they don't trade the same week because they have different filters. So for example, here, this is the long side buying, the long side buying, the long side buying, but the short side only happening here. And of course, this will be different every week. So again, here we have both of them trading. Here we have one of them. Here we have both of them. Here we have none of them, and so on and so forth. So the filters will play a big role. And the result of this combinations is we have about 1,000 trades. On average, they're making $300. The long side is $200. The short side is $450. This is the equity curve, and it's amazing. It's going up all the time since 2007. Overall, we are making 300,000 with 5.6 return to drawdown ratio. An annual period analysis from 2007 all the way to the current year, 2024. Now, remember I told you you can do this on any bar, and I did the same sequence on 180 minutes on the Japanese yen. So here is the Japanese yen 180 minutes bar. And again, we're using the daily bars for the filter. And the Japanese yen almost double the margin requirement for the Australian dollar. So to compare it to the S&P 500, we need to trade about 4 contracts. And as you can see here, I'm trading 4 contracts. And the result of this strategy is 164 with 8.5 return to drawdown ratio. This is how the curve looks like. And we're making about $440 on average on the short side. Annual period analysis, we have 2 losing years. Now, of course, you can apply this concept on every single instrument in the universe because every instrument will have its own pattern. Stocks, ETFs, Forex, futures, crypto. But of course, not all of them will yield a good pattern. So some of them will not yield a good pattern, even though the pattern exists, but probably there's not enough money, or the win rate is low, or the drawdown is big, and so on and so forth. If you like this video about intraday seasonal strategies, then you will love the next video.